Stocks on the rise again after the president extended the ceasefire with Iran. So it really has been another terrific run for this market off the lows reached kind of early in the conflict. As Doug Flynn joins us with more from Flynn Capital Management. Hello, Doug. And I said I would have a chart. This one on the telestrator of the wartime stock market keeps rising. Kind of tells the story. This is all three: Dow, NASDAQ, S&P 500. S&P's in green, but you can see, right in here when the war started in March, we did see the market start to go down. Yes. But it was even before the ceasefire that the market started on its way up. So, 7% down, and now I think we're up 10% on the S&P. So describe for people kind of the mentality of all this.
I think it's almost like the way people treat the weather. They treat it seriously but temporary. I think that's the kind of mentality you have. And I think stocks are rising sort of despite the conflict, not because the conflict is over. There's other things behind this. There's the momentum, you have earnings. And so I also think that, a year ago, there was a big drop in the market. This is last April with the tariff tantrum. The stocks were down 20%. And do you know what the market is up from those lows a year ago? Like a year ago to today, do you know what the market is up?
I actually don't.
It's the S&P is up 40% and the NASDAQ is up over 50% from a year ago. And so
that's 52 weeks. So that's
52 weeks.
Wow.
And so I think people feel like they missed that buy the dip scenario that happened a year ago, and they didn't want to miss it this time. So they started to buy the dip. And so they layered in some of their dollars. And then you have some people that were kind of risk averse that sort of took those trades off and got a little bit reinvested. So looking beyond this conflict is what's going on.
To your point, it's more than the war. So like Tesla reports earnings tonight, so you'll watch earnings. Boeing had numbers. They didn't make money, but they didn't lose as much, I don't think, as people thought in the stock. When I said it was up like 5%. So, and then you get back to the AI story. So before the war, it was all the, hey, AI is going to drive us. It's going to make us more efficient. Yeah, it might impact jobs, but in the short run, it'll make companies a lot more money. So are we just back to where we were, or maybe it never really went anywhere? The same story that's driving things?
I think the market would be even higher if we didn't have the noise from the war and oil prices. And so I think that, although it's looking past that, we don't have it all clear here. There is still the threat of inflation and these other things that are carrying on. And so I think that's in the background. But once you get beyond that, you do look to this amazing corporate earnings run we have and all these other factors. And so I don't think you just jump in with both feet because everything is solved. But I think people, between fear of missing out, the FOMO situation, and not wanting to miss the run here, and all those other good factors that you see beyond it, yes, you move back to what's still in place. I oftentimes joke with clients, I'm like, is Apple going to sell any less iPhones because of what's going on overseas? I don't think so. And so when you look at it like that, these companies are still executing quite well, and in some cases better than they ever have. And so I think
so it's not the same story then, right? Stocks and oil, you could separate those. A lot of times we say, let's separate the stock market from the economy. Back to the telestrator, I have the global benchmark for crude oil, which is Brent, up above 100 again, okay? WTI, our oil essentially, the American benchmark in the 90s. So they could hang out, at elevated levels, and gas prices could stay up around $4 for quite some time, and the stock market could still do well.
It could. I think what happens, though, if oil does stay elevated and inflation expectations rise and the disruption in the Strait just gets worse, the market's going to have to reconnect with the fundamentals, and eventually those will come back in line. So right now it's a little bit of a disconnect.
Because the economy would be slowing, right? There'd be an economic slowdown.
Correct. Yeah. That's right. So then it would impact those longer-term numbers, and I think then the market could drop, and when it drops, it could drop again. And so then you get back to that scenario: do they buy that dip because the long-term outlook is still good? If fundamentally nothing has changed long-term, that's why you don't want to worry about this stuff day to day. You want to think long-term. But if something is going to fundamentally change, you have to be a little more concerned and look to those other areas and not just stocks all the time and tech all the time. So diversification paid off really well this year by having those different things, as the tech went well and then didn't, and now is doing well again.
All claps for you, Doug, again at the New York Stock Exchange. They love your reports.
We'll take it.
Yep, and the market is closing there.